Hello, I'm Alicia Ogawa. I'm the director of the project on Japanese corporate governance and stewardship at Columbia Business School. Today's webinar is also part of the Columbia Business School Phillips Pathway for Inclusive Leadership, or PPIL. The PPIL is a co-curricular program aimed at equipping business school students with the essential leadership skills necessary for leading and managing diversity across industries. For any MBA students attending our webinar for PPIL credit, please check the chat for directions and our self-check-in kiosk link. So good evening to everybody in the United States. Good morning to friends in Tokyo. And for everyone else dialing in from other locations, thank you for finding the time to join us. This is bound to be a lively discussion on exactly how do fund managers use their powers to advance agendas that look beyond quarterly profits. That is, to encourage corporations to embrace a longer-term strategy that ties stakeholder and shareholder interests together. Let me reduce the history of these trends to a few sentences. The global financial crisis of 2008 was followed by years of exploding growth and income inequality. And in addition, the crisis of climate change began to accelerate. The Paris Agreement, under which countries pledged to work to hold back global warming, was signed in 2016, and Pope Francis declared a global climate emergency in 2019. In reaction to the strength of public opinion on these issues, business leaders faced increasing demands to respond. In the United States, the Business Roundtable, which is an association of United States CEOs, which is very much like the Keidanren in Japan, the Business Roundtable issued a letter in 2019 promising to run their companies for the improvement of the welfare of average Americans. And at about the same time, Larry Fink of BlackRock published the first of his annual letters swearing that he would use his company's power to improve the environment. But much of the investing public quickly came to believe that these were just hollow words. CEOs continued to pay themselves handsomely and to pay many of their workers very poorly. Companies seemed very uninterested in making any real changes to their businesses that would improve the climate crisis. So angry and frustrated asset owners, such as pension funds and smaller investors, even at the retail level, began to demand that asset managers use their investments to work to promote change. In Japan, we see similar trends, although investor pressure seems more focused on governance issues than on social or environmental issues. I'm simplifying things here, but the Corporate Governance Code was passed in order to demand that corporate managers run the company for the sake of shareholders rather than just employees. And the Stewardship Code was created to demand that the asset management industry hold executives to the promises that they made in adopting the Corporate Governance Code. This was then followed by a mad rush of Japanese companies signing on to the United Nations Global Principles of Responsible Investment. But tangible and strategic changes in Japan have been as difficult to see as they are in the United States. I should hasten to add that while all of this was happening, this is very important, a branch of financial economics began to push the view that so-called ESG investing styles are an essential tool for managing non-financial risk, not just for accomplishing social goals. And more recently, a new school of thought has emerged that calls into question the very premises of modern portfolio theory, or MPT. MPT says you can't control how wildly the market swings. All you can do is choose stocks that will outperform the market, whether that means they gain or lose in absolute value. You could choose stocks that outperform the market but actually lose value. So the new school of systemic investing argues that you can reduce the risk of the total market by attacking some of the long-term trends that periodically make it go crazy, like climate events or economic crashes due to bubbles, or political instability due to income inequality, or global health events such as COVID. So you have a situation where political pressure, changing social norms, and evolving financial theory all combine to put the pressure on the asset management industry. Asset managers are expected to use all the strategies and tools they have to push companies to consider the longer run, and to take into account a wider range of issues beyond the company itself. We're going to hear from two speakers tonight exactly how they do that. It's not as easy as many of my students believe. For example, is divestment of shares in fossil fuel companies a more or less effective strategy than using share ownership as a means to engage with the company to promote change? Is a noisy public campaign to change the board more or less effective than behind the scenes negotiations? And how do global asset managers deal with differing rules, differing laws, accounting regimes, and customer preferences in the many countries in which they operate, when issues such as climate change and diversity are by nature very global problems? So with me tonight are two very thoughtful and experienced people who are charged with figuring all of this out. I'll start by turning it over first to Sarah Bratton Hughes, Head of Sustainability for Schroders North America, and then we'll hear from Mr. Kei Okamura, Director of Stewardship at Neuberger, Berman, Japan. We're fortunate to have these people from two companies who are both considered global thought leaders on these issues. I've given them 5 minutes each to introduce themselves, and then we'll dive right into the conversation. Please post any questions you have during the discussion in the Q&A box, not the chat box, and we'll do our very best to get to them. So without further ado, may I turn it over to Sarah.
Thank you so much for having me here tonight. I'm not quite sure we're going to figure out all the world's problems in 1 hour. And thank you all for taking the time today. Good evening to my friends that are also based in New York, and good morning to my friends out in Tokyo. I'm just going to take a few minutes to tell you about Schroders, our commitment to sustainable investing, and my role here. Here at Schroders, we are a 200-plus-year-old asset manager. We are 100% focused on active asset management. We invest over $700 billion on behalf of our clients globally, operating in 34 countries around the world, including here in US, as well as an office in Tokyo as well. Sustainability is really embedded throughout our culture. We have a firm commitment to active ownership and stewardship here at Schroders. We actually started our sustainable investment team back in 1998, and we've continued to invest and grow since then. And we started our team at the time because we truly believed that if we took into account these pre-financial risks into our investment process, it would lead to better long-term risk-adjusted returns over time for our clients. So we are a 100% fully ESG integrated firm here at Schroders. We have a global ESG team, and I'm sure we'll get into why we believe that is so important. The bulk of our team is located in our London headquarters. I'm on the ground in New York, and we have individuals on the ground in the region in Asia as well. Sustainability has and always will be an investment function here at Schroders. This is about maximizing return, not about policy, and not about marketing. Our team is most well known for our 10 proprietary tools and frameworks, all with the aim of taking long-term structural trends and turning them into actionable investment implications. What does that mean in practical terms, and how do you do that? Well, I've never met an investor, an analyst, or even I don't speak in carbon footprint, right? That's not the language that investors speak. However, when you can create a model that helps you stress test your portfolio for the impact of rising carbon prices, you're then translating that into the language that investors speak, which is data and dollars, or yen, euro, pounds. So you're quantifying it into the language that investors speak. All of our tools are built upon this premise of quantifying sustainability risks and opportunities. Because we can quantify, we can then measure. We measure at the portfolio level sustainability factors across all of our assets here. So that's both corporate assets, muni assets, sovereigns, private assets. here at Schroders, because we can quantify and measure, we can then manage. And you manage two ways. One of the largest ways we're here today is via active ownership and stewardship. So we have a robust active ownership and stewardship program here at Schroders. We engaged with over 2,100 companies across 58 countries globally in 2020. And we've actually been tracking our engagements back over 20 years. So we can go back and assess the progress and influence we've had. And the other way we manage is via the products and solutions that we can offer to our clients. So we have the entire spectrum here, everything from integrated to impact across public and private markets. I started this by saying we do this because we truly feel it will lead to better long-term risk-adjusted returns for our clients. But sustainable investing isn't something we just do from an investment perspective. It's really embedded in our culture here at Schroders. And we believe by truly embedding sustainability, it will lead to long-term better risk-adjusted returns for our shareholders as a publicly listed company on the London Stock Exchange. So we were the first asset manager to tie our cost of capital to sustainability goals. So the rate on our revolving line is tied to us achieving, we get a more favorable rate if we achieve certain diversity as well as climate goals. We're a signatory of the UN Global Compact. And I always say we have such ambitious climate goals as a firm. As the sustainability person, I think I'll be doing Zooms for the rest of my life and never allowed on a plane again. But that does bring me to myself. I often tell people I have the best job in the world. I truly really enjoy what I am doing because I believe I can make the world, and most importantly, investment returns more sustainable for the long term. So here at Schroders, I lead all of our initiatives in North America as it pertains to sustainability. That's everything from our go-to-market strategy, how we think about marketing, client development, client engagement, product development. But the most fun part of my job is on the investment side. So I'm working closely on ESG integration, and I lead our initiative here in North America for all of our investment desks we have. We have a large US equities presence, mostly down the cap scale, multitude of fixed income, everything from US munis to high yield, emerging market debt, investment grade, as well as securitized fixed income. And we also have a private assets, private capital business here. Broadly speaking, I sound like a generalist. I am when it comes to sustainability, but I think everybody in sustainability has that one topic that they really specialize on. For me, I'm very focused on the concept of quality jobs. I could spend the whole hour talking about it, probably the whole day talking about it, as well as diversity and inclusion. So I'm really looking forward to this discussion we're going to have today.
Thank you very much, Sarah. That was a great kickoff. Can I ask Okamura-san now to follow on for 5 minutes introduction of himself and his company?
Sure. Thank you, everybody. My name is Kei Okamura, and I'm the Director of Japan Investment Stewardship at Neuberger Berman here in Tokyo. I second, Sarah-san's comments about finding this job to be incredibly worthwhile and something that is actually a very big driver of why I'm in this profession. I think that's an important part of what we're going to be discussing today, is that we are trying to make good this world, but at the same time we want to make investment returns sustainable and maximize them over the long term. And I think that is the mission of what we're trying to achieve here at Neuberger Berman. So just to give you a quick overview of our company, if we could just pull up the presentation and jump to slide 3, if that's okay. Neuberger Berman is an asset management company that was established in 1939. We are 100% independent owned by the employees, and we have global operations across 25 countries. We integrate ESG across all of our investment assets, and we try to achieve long-term outperformance through active investing and engaging companies and issuers. If we could flip over to the next slide, please. In terms of our ESG capabilities, we've listed here a couple of our sort of unique traits, if you will. We have a proprietary research database covering over 5,000 companies, which we leverage to have a pretty deep understanding of our holdings. And as mentioned earlier, active engagement is a core part of our process. So last year we had over 3,600 engagements across both the equities and fixed income. And we also have fairly unique tools in our engagement strategies, such as NB votes, which we welcome everybody on this presentation today to definitely visit our website. It's an initiative that was started from Neuberger Berman that aims to pre-disclose our proxy voting ahead of the shareholder meetings, and I'm more than happy to give a little bit more details on that front. If you could just flip over to slide 6, please. Wanted to just quickly give you an overview of how we see investing in Japan. We always start with this presentation slide when we communicate with external clients and the public. For many people that see Japan, but maybe have been seeing it a little bit passively, we think the picture of what's happening in Japan in terms of corporate governance, sustainability, might be on the picture on the left, which is still waters, not a lot of change. But actually, as practitioners of Japan equity investing in this market, we see the picture on the right, which is that there's a plethora of investment opportunities beneath the surface. And this is really a result of all of the corporate governance reforms, the changing of the mindset that we're seeing amongst companies here in Japan. If we could flip the next slide, please. And so, this is actually one of the key topics I think we're going to be discussing today, is that what makes Japan attractive, and why do we think that's the case for the mid to long term? Well, first of all, Japan is a highly inefficient market, we think, with an abundance of undervalued and under-researched investment opportunities. Just to give you an example, in the small cap space, there's about 90% of the companies there have less than 5 sell-side analysts covering this market. If you compare that to US and Europe, that's about 30% and less. What's even more interesting is that a quarter of that market have 0 analysts on the ground. And so, like Sarah-san mentioned earlier, it's actually quite important that we have people on the ground to be really digging up these investment opportunities and really looking for great investment opportunities for the mid to long term. And these companies, if you look historically, have tended to be market leaders with disruptive technologies and battle-hardened balance sheets that have survived the decades of stagnation in this market and have actually become global leaders in their niche fields. And what's really interesting, and I think this is something that we're going to have a really good discussion about today, is that these companies have often been ignored if you look back, the past 10 or 20 years, but they are now open to engagement by minority shareholders like us, and who are willing to unlock their hidden values through engagement on financially material issues that can ultimately achieve good, sustainable long-term growth. And that is a really key part of what we do. And I'm really looking forward to sharing some of the great examples that we have in our recent investment holdings.
Great, thank you very much, Okamura-san. Thank you very much, Sarah. I think we can retire the slides and bring everybody back. Yeah. So I'm going to ask us to take like 50 steps back. And I'm going to ask a couple of really basic questions because, first of all, I think there probably are some people on the call who are not as experienced as certainly you two are. But I also find that sometimes asking very basic questions can elicit some surprising responses. So I want to ask a couple of questions that you can each jump in, or I'll cue you. Let's talk about how you define ESG, how you define stewardship, how you define engagement. I mean, I teach seminars at the International Affairs School on ESG, and students, will always come in with the various slide they found. It appears everywhere, right? Where you have negative screening and best-in-class portfolios and thematic around climate or whatever, or impact, right? So that's a thing that students always come in with. And then we have very big, sort of debates, or they want to have very big debates about why you should or should not own Exxon stock. But I've taken to telling them that ESG strategy simply means engagement. You can own anything as long as you're engaging with the company. That's a kind of ESG strategy. But if you could both talk to me about how you define ESG, how you define stewardship, what is engagement, what kind of forms can it take? And I also want to finish with one other question, which my students always, have a problem with, which is that many students imagine that you simply buy good ESG stocks and you never buy a bad ESG stock. And they have this concept irrespective of valuation or irrespective of future outlook or irrespective of maybe changes that are starting to happen. So if you could take a stab at any or all of those, maybe I could let you go first, Okamura-san, because I'm looking at you. You're the biggest on my screen.
Oh, thank goodness for Zoom. Sure, I'll be happy to. When we engage companies in our investment holdings and in our portfolio, we prepare like a 40 to 50 page presentation deck for each company, and it has customized feedback. But at the very front of that presentation, we define ESG, just because you're absolutely right to point out that this part actually does need to be clarified. In our definition, ESG is financially material issues, period. And this encompasses all of the factors that are related to sustainable growth of the company and the business fundamentals. So I think recently there have been a lot of focus on ESG and sustainability, but I think from 5 to 10 years from now, these words will probably not exist because they will be part of active investing. In terms of your second question about stewardship, I mean, this is, if you look it up in a dictionary, it does mean just being a responsible investor. And again, this term stewardship will probably not exist in 5, 10 years, because if you're not a responsible investor, then you're not really doing your job. So, but the point here is that addressing these financially material issues to companies, identifying what they are, where that needs to be improved to achieve long-term sustainable growth, that act in it of itself is being a good steward. And then communicating that effectively to companies is what engagement's all about. And engagement is not just about face-to-face meetings. It's about effectively communicating. So that means in speaking, in writing, in NB votes is something that we use, proxy voting essentially, and likewise also collaborative engagements, working with peers on certain universal topics. I think these are all part of the definitions. And in terms of your second question about buying good ESG stocks, actually in our approach, we invest in high quality companies that will achieve mid to long-term growth, and will probably likely achieve them regardless of our engagement. However, it is through our engagement that we think these companies can sustain that growth over the mid to long term and can actually outperform peers, because we communicate with them on what are the key issues that need to be addressed immediately and how that could actually get them to strengthen their business models and address the key issues that could potentially affect their mid to long-term growth.
Yeah, can I ask Sarah to respond to any or all of those questions?
I knew I would forget it. I got it on question 1. I forgot the mute button on question 2. Yes, listen, you gave a number of definitions. And to me, ESG integration is not an investment style. It's an investment philosophy and process. It's systematically incorporating these pre-financial risks and opportunities into your investment process, a firm commitment to active ownership and stewardship. We also approach ESG integration from a very inclusionary perspective. So what does that mean? We're not just blanket screening out certain industries or sin industries. What we are doing is, as I said, systematically assessing sustainability across a number of factors as part of the traditional investment processes. And this is going to flow right into your good or bad ESG question. That doesn't mean we won't have a company in there that has one aspect of ESG that's rather poor. Actually, we could have companies in our ESG integrated portfolios that are poor on more than one aspect, but we understand that risk. We're getting compensated for that risk. And that risk most often manifests itself in position size, if you're looking at fixed income, in the duration of the bond you're choosing to buy. And what we're here for tonight, how we're actively looking at that company from an active ownership and stewardship perspective to unlock that long-term value for our clients. Everybody's always trying to distill ESG down to good or bad. I know we'll get into the ratings agencies, a AAA rating or 100 on Sustainalytics, but actually that's not what it is. ESG is not a number or a rating. ESG is a series of questions that you should be asking across multiple stakeholders to help understand the long-term sustainability of a company's business model and durability of an investment's cash flows over time.
Yeah, I think one of the examples I tried and failed to get my students to contemplate at one point was, if you remember back to the Volkswagen Dieselgate scandal, where they were found to be falsifying emission data, and the share price dropped by 30% in a month or something. And I had a case study of an asset manager who was very highly regarded as a sort of ESG manager, come in and buy tons of the stock because they felt the company was at an inflection point and they could make a difference. And I find that students have a hard time getting their heads around that. Everything is not black and white all the time. And it's in a continuum. Everything exists in a continuum. So I want to find, you touched on this, Sarah, so maybe I'll pitch this at you first. Both of you keep saying integrated ESG or integrated sustainability. How do you use, what does that mean? Who gets to make the decision on buying or selling a stock, increasing or reducing the position in a portfolio? Some companies seem to have an ESG team that sits on a different floor, and maybe there's a committee, or sometimes the portfolio manager is given complete discretion on everything from opining on ESG to deciding how to vote at the AGM. So please talk to me about, what does integrated ESG mean? And since you brought it up, talk to me a little bit of how you use ESG rating services like Sustainalytics or MSCI. What are the strengths and weaknesses of ESG rating services? And clearly, you don't regard them as the be-all and the end-all, because both you and Okamura-san have your own internal systems.
Sure. So I'll start with the team first and how our teams function. So
what does integrated mean?
Oh, yeah. So we are actively integrating sustainability across all of our asset classes here at Schroders. In order to understand what that means in the construct of our investment process, the first thing you have to understand is Schroders operates as a series of boutiques. That means each investment desk has their own individual investment process. While we have a centralized economics team, each investment desk is making their own decisions. It's not a shared research function. So you have to understand that that's a little bit different than maybe how some other firms are structured on the street. So each individual investment desk is utilizing the flexible tools and frameworks that are, as well as the specialty knowledge that our centralized sustainable investment team is providing to them. And I think it's really important when we're building out these tools to build them out and ensure that they are flexible, right? Because what is good sustainability for a European large cap company is very different from a US mid cap company or a Japanese micro cap company. So we're building out these tools. We're working with our large data insights unit, who's helping us pump in both traditional and non-traditional sources of data when we're looking to holistically assess a company's sustainability perspective. Our team sits on the investment floors, no matter what office we're in, whether we're in Singapore, whether we're in New York, and whether we're in London. We are sitting on the investment floors with investors. This is an investment function. We are using sustainability to maximize long-term risk-adjusted returns. Our fiduciary duty, above all, is to maximize long-term risk-adjusted returns for our clients, and sustainability we view as a great lever to help us achieve that. Sustainability is not an outsourced function here at Schroders. So what does that mean? I said we were building the flexible tools framework, providing them with the specialty knowledge, doing all kinds of thematic research, helping them with the engagement process. But at the end of the day, the investment decision lives with those who know it the best. And that's our investment desks. So it is very much integrated, documented into the process. Also, sustainability is part of our independent risk function here at Schroders. So we have a flagship tool, SustainX, that helps us quantify in its simplest terms. It is not this simple. You can go on our website and download the 37-page document that describes how we built it. But in its simplest form, it's quantifying future sustainability risk, as well as our carbon VAR tool that's stress testing a portfolio for our carbon prices. Those are actually also part of our independent risk review process that all of our fund managers need to go through. So what does that mean? We have an independent investment risk team. They're asking about traditional forms of risk, whether that's alpha, beta, sector limitations, but they're also asking them to assess and explain their sustainability risk as well. So it's really holistically embedded throughout the life cycle of the investment process here at Schroders. When it comes to third-party ratings, one of our fund managers says it better than anyone else. Using third-party ratings would be like wearing somebody else's glasses. I couldn't see clearly. Just because we wouldn't, right? And our fixed income investors will slam on the table and say, nobody would ever tell me to go out and buy a bond because Moody's has it AAA rated. I'm compensated for finding those inefficiencies in the market. Why is it okay for me to go out and say, just because Sustainalytics or MSCI has a company rated, to buy it as well? So, and if you're going to authentically really embed sustainability into your investment process, bolting on a third-party rating is not that. And I'll tell you why. First of all, ratings are inherently backward-looking, but there's larger limitations to them. First and foremost, the ratings are, there's a lack of transparency. We've done a lot of work on this. There is very little correlation. If you are highly rated amongst, we've looked at the 3 main rating agency providers, Sustainalytics, Refinitiv, and MSCI. There's very, very little correlation. If you're highly rated amongst one, you'll be highly rated amongst the other. The other big aspect is that they're based off disclosure, right? So you end up with the factor biases in your portfolio. The European and large cap companies that have large IRs, large investor relation functions, tend to do better because they can disclose more. And disclosure on its own doesn't necessarily mean it's embedded throughout the enterprise risk of that company. And I'll just tell you a favorite one of my company stories. Unfortunately, I can't give you the name because my compliance department
would kill you.
You said it, not me. But we have it. There's a company. And the company is actually headquartered in Switzerland. However, the growing part of their business is in the US Southwest. They are a plasma company. They're, if you looked at their third-party ratings on the worker pillar, because they're headquartered in Switzerland and have all the Swiss and European disclosure, they get fabulous ratings across the worker pillar. But the growing part of their business is in the American Southwest. Who's a real material stakeholder to a plasma company? A company that's literally harvesting plasma from our arms. We're going to donate it. We need somebody that knows what they're doing, health and safety. It's regulated by their government. Then they're taking their product. They have to transport that safely. Who's very material to them? The worker. And what we found, actually, one of the ways our data insights units help us is they're actively tracking Glassdoor or the equivalent reviews. Now, we're not trading off a Glassdoor review, but what we were seeing was in the US, which was their largest growth engine, their reviews were horrific. And the worker is their most material stakeholder. So for us, it was a point for us where we went to management and said, explain this. What are you doing about this? And we wanted to understand what were the policies and procedures they were putting in place? What were they doing to retain their staff? How were they ensuring that Staff were trained in safety procedures, because the last thing you needed was new staff and the same day the FDA decided to visit and shut down your facilities. So there was a number of things, and we continue to monitor it. What we're not looking for is this massive improvement in Glassdoor scores, because management was giving everybody $100 gift card to Starbucks. And they gave them 5 ratings. Actually, there is this little indicator on Glassdoor, and it says, would you recommend a friend work here? And that's what we were looking for. And we saw progressive improvement with the company. And we also saw progressive improvement with the share price. But if we had just relied on the third-party ratings, looks great.
Right, right.
High rating, rated in Switzerland. So there are a number of issues with them.
Yeah, I'm going to ask Okamura-san a slightly different version of the same question, essentially, which is Sarah's talked at length about why relying on third-party ESG rating companies is problematic. But I find that to be even more so the case in Japan. I may have sent you that paper about aggregate confusion of ESG ratings, where we see that very often Japanese companies, there is no consensus among the ESG rating companies how to rate the Japanese companies. I think part of it is Japanese companies are not necessarily good at communicating. Secondly, maybe the things they're being asked to be rated on are not so relevant in Japan. But yeah, how do you use ESG ratings? What are the limitations, particularly in Japan? And how do you think Japanese companies are striving to get better ratings from ESG rating companies?
Sure, that's a lot of questions. I'll try to get through all of them. To answer your questions about the ratings
The floor
agencies.
for a long time, so I thought I should give you the same time.
Sure. To answer your questions on the ratings agencies, I just want to quickly go back and answer your question about the ESG integration part, because that is quite important. So our firm is similarly structured as Sarah-san's, but the way it works for the Japan strategy is that ESG integration is fully embedded in the actual investment strategy. And what do I mean by that is we have a scoring model that basically rates all of our companies. The higher the score, the higher the portfolio weight, vice versa. And in part of that scoring, we actually have a fairly chunky portion of that dedicated to governance and environment and social issues, and how companies are tackling them and how they are looking to address them in the mid to long term. Some of our peers in this industry are taking a different approach, where they have an existing portfolio that's been around for decades, and then because of the trends of the last several years, have added an overlay of ESG screening and possibly analytical factors, and then they rebranded that and repackaged that into an ESG fund. Lots of pros and cons. I won't get into the debate, but as you can see, there's a fairly big difference in those two approaches. So in our approach, that's how we integrate ESG. And the reason why we have that approach is because the people that are actually analyzing these issues, these sustainability issues in terms of environment, social, governance, of course, is not a separate sustainability team or an RI ESG team. It's the actual fundamental PM and equity analysts like myself or the rest of the team members. And the main reason being is that the best people placed to analyze and engage on these topics are the people that are doing the actual fundamental analysis and are doing the actual decision making in the portfolio level. And unless those two are put together, we are of the view that the communication to companies will be dislocated. And I've seen that in person in previous companies that I've worked for. Again, lots of pros and cons there. I won't get into that. Now, in terms of the ESG rating services, this is certainly, I echo Sarah-san's comments about the challenges that a lot of these companies, ratings agencies face. Some of that has to do with the, very simple reasons. The fact that, these ratings agencies have a lot of companies to look at with very limited resources and limited number of analysts. So you can't expect them to be doing deep dives like us, fundamental equity people that are actually looking through the filings and then from there using that to communicate with the company and talking to these companies over many, many years. And many times these ratings agencies only have a mere days to do this analysis work. The other issue is that their focus is on primarily at the moment large cap, mid cap, highly traded companies, and for right reasons that these are the companies that attract the most investors. But in our view, we think that the alpha generation will likely come from the small to mid-sized companies that will go through the ESG transformation from laggards to leaders. And in that process, they'll go through a discovery phase where the sustainability funds of the world or the ESG tilted long only funds will find these companies and say, hey, look, this company is actually doing better than they were 5 years ago. Why don't we have a look? And as these companies initiate in these companies that we've already had a position in, we think that that will result in alpha generation. And the main reason why these companies are improving is because of investors like us that are approaching these companies and giving them the 40 to 50 page presentation deck, going through the ABCs of ESG and telling them where exactly they need to address. And that answers your last portion of the question is, the difference in between ESG ratings in Japan and the rest of the world. You're absolutely right. There are some issues with the universal approach that ESG ratings companies take in Japan, which is why whenever we approach companies on these issues, we give them a slide that has all of the ESG ratings agencies and their updated scores on each company. But we also show them where they lag and where they are considered positively. And then in that process, we tell them these particular issues are very pertinent to your business model. So make sure to hit these points. And over time, you should be appropriately rated by these companies. And a lot of the companies that we hold in our portfolio have seen that come to light in the last several months.
Yeah, you've both touched on, made passing reference to the difference between large cap companies, Sarah said, who have, big IR operations, investor relations operations, and you mentioned that small companies, need your more help perhaps. And I think that this is one of the questions I always ask myself about the costs that we are imposing on ourselves and companies if we're requiring huge amounts of standardized reporting on ESG metrics. Because clearly smaller companies will be at a competitive disadvantage. And I just worry that at some point, maybe all these demands for new information, particularly standardized information, will have a chilling effect on competition. I've got a good friend in Japan who has a startup in a sort of information providing kind of ESG kind of stuff. And he says, I can compete on, he runs assets, so I can compete with Larry Fink on return. I can't compete with him on morality. Like, I don't have the money to hire, a ton of, chief learning officers and chief diversity officers and, ESG, IR people and blah, blah, blah. So, yeah, I worry about that. What do you think about this move to standardized reporting that is being rolled out by various, whether it's TCFD or SASB and IFRS? How valuable do you think that is, Okamura-san?
I think it's very valuable because if speaking to many companies, big and small, they all have the same view that the environment for ESG reporting is chaotic.
Yes.
But that's why we think that our approach, when we look at material E&S issues, one of the first things that we look at as a starting point is the Sustainability Accounting Standard Board, SASB. And we are fully supportive of the recent trend that they decided to merge with IR. And then we think that this trend will likely continue. And we actually think that it's great that SASB is in the middle of it and trying to create industry consolidation. And this is going to, I think it's going to lead to a fruitful outcome in the end. With regards to your question about, earlier about, for small cap companies versus large cap companies, you're absolutely right. I mean, some of these companies that we hold, they have only 1 or 2 people at the IR department, 0 people in the CSR department. You look at companies like Toyota or Panasonic or Daikin, they have troves of people and have nice big thick integrated reports. Great. But the problem is that then for small cap companies, within the limited resources that they have, they still need to produce outcomes. And that's what we're doing in terms of our approach, is that, we are pointing out the material issues that need to happen. So I'll give you an example. we hold a facility management services company. It was founded by the current CEO. He's very charismatic, and this is a typical sort of family-owned company. Essentially, his voice is literally the voice of heaven. Everything moves. And that's one of the strengths of small, mid-sized companies, is that if you can hit at the heart of these leaders, then they will move a lot quicker than any of the large cap companies that we've seen. And that's, I think, one of the beauties of our approach, is that because of our active engagement, we really do meet with management who at first are very skeptical of why we're there in the first place and why we're even talking about ESG. But then through our very, very long engagements, some of them span, years and decades, not decades, but yeah, certainly years. It gets to them. And recently, that facility management services company had a results presentation on live stream results presentation, and he himself went on camera and discussed about the company's ESG initiatives, the same issues that we raised to the company, and he pointed out a midterm plan on how he plans to address them. I mean, and from now onwards, we expect the company to be on the move very, very quickly. And I think that's some of the beauties of addressing these issues for small, mid-sized companies.
Yeah, you just kind of, I don't know how to phrase it. You kind of brought up a small contradiction that I'm not sure we have time to really discuss, but fascinates me. You said that this guy who really moved quickly, who is the CEO, who's very dynamic and charismatic, and when he speaks, heaven moves. Well, that's not necessarily good governance, is it? I mean, and this is one of the contradictions I find really amazing. And in London, I think where there is this really serious effort to separate the role of chairman of the board, chairman and CEO, and yet all of the best companies, all the most productive companies, all of the most profitable companies, that's not the case. So there's a lot of room for active managers who can identify value without getting pedantic about it, like you and Sarah. But Sarah, there are so many good questions from the audience too, and I'm sort of losing my trend of thought because I had my questions organized, but I want to get to some of the questions in the audience because they're really good. There is a question that says, would you mind giving a few examples on how to tie your cost of capital to sustainable goals? Can I throw that one to you, Sarah?
Yes, so we have our cost of capital tied to both diversity and environmental goals. So the environmental goals are tied to us meeting certain scope 1 and scope 2 emissions reduction targets. We can go into scope 3, that will be another hour and a half that we don't have, but they're focused on scope 1 and scope 2 right now. On the diversity side, I think what we have seen is the studies don't lie, and nor does the performance. More diverse and inclusionary asset management houses perform better. And we have targets around gender diversity for the number of women on the boards, on our board, as well as the number of women within management. We've actually achieved both of those and are putting them up a little bit higher. We're raising our own bar over here to be more representative of the general population. And I would anticipate us within the near future on broadening that out to other forms of diversity, whether that is ethnic diversity, or we're also very focused on disabilities and ensuring we have that disabilities as a major, we are an inclusive workforce for that as well, because actually 13% of the world's population has a disability as well. It's often the overlooked form of diversity. So those are just a couple of ways that we are doing that here at Schroders.
Thank you very much. Okamura-san, there's a question from the audience from, I'm going to butcher the name, it's a Mr. or Ms. Azimi, who says, why are Japanese global corporations so timid and disengaged about the great ecological and social challenges of our time? That's a pretty heavy question. And I would add to that, I mean, my observation would be that Japanese companies tend to treat sustainability and ESG issues as a kind of compliance function, and they're really good at reporting on it. Like you said, tons of really thick integrated reports, but yet I don't find that it's always the case that it's a kind of strategic approach.
Yeah, that's a very good question, and it's something that I discovered not on day one, but actually through discussion with companies and actually looking through the history. A lot of Japanese companies are actually not disengaged, but I think they are timid about this issue, the great ecological challenges. One of the reasons why is because a lot of companies actually do address environmental issues, and they have historically for various reasons. If it's a chemical company, for instance, it's part of the law that you actually have to address these issues and disclose. If you are a transportation company or a railway company, for example, similar things. But if you actually look under the hood in terms of how these are being disclosed, they're very formulaic, and it's only about what's happening on that year. It's not part of a materiality framework. It's not part of a sustainability strategy. And therein lies the problem, where these companies have historically done all of this sort of disclosure. Their entire company divisions, CSR divisions, are actually all based on that disclosure framework. And now foreign investors and now also domestic investors are coming to them, but talking to them about these issues from a different lens and addressing them from a materiality and a sustainability initiative, and something that's more on a management level discussion. And that's where the dislocation is happening. And so a lot of companies, they have this treasure trove of information, but they don't know how to disclose them. So a very important part is to bridge those two different parties and to get them to understand that there are pieces of the puzzle on both sides that can work together. But the most important part is that management needs to be committed on these issues to address them, and they got to connect the departments within the company to talk together and to try to figure out how to weave that into the management strategy. Because I think that's one of the reasons why a lot of companies face such challenges in addressing these issues from a global perspective.
Yeah, I do still feel very sympathetic to Japanese companies who are receiving, sort of proxy agendas from big foreign firms that say, we're going to vote them against management unless you have 6 independent directors, or unless you have all these sort of Western kind of things, not taking account of the idea that not just Japan, but other countries in Asia or other parts of the world, have different issues. Again, we chatted about this, but why aren't we talking about earthquake, protection in Japan, earthquake preparedness, or why isn't Japan being more forthright about, or forceful about, explaining that the ocean is too deep to have, ocean wind power, the way that some clients are demanding. Anyway, I'm going to move on to some of the questions for the audience. I'm going to toss one to Sarah, because this is a good question. And I think, everything you said right up until now kind of explains this a bit. The question is, let's assume that ESG is for maximizing risk-adjusted long-term return. Do you think we have an ESG bubble right now, at least for some stocks? If I was going to take a swing at answering that, because I want you to push back on me, I would say, well, that's not talking about ESG investing philosophies or styles. That's talking about ESG labeled products, right? So there's a difference between an ESG ETF performing well or badly, or a stock that has the investor is taking an approach that you have described. But why don't I let you answer that question?
So there are parts of the stock market that are overvalued right now. But when I talked about ESG as being embedded, part of our philosophy and process, I think what this question is talking about is investment styles. Now, right. We can very easily, the easiest way to do this, the impact management framework has they have a great framework to help distill the investment styles. A, B, C. I keep it real simple. I didn't go to Columbia. A stands for acting to avoid harm. That's when you're doing a negative exclusion or an exclusionary approach. B, that's when you're focused on benefiting stakeholders. So that's when you'll see strategies that have maybe the ESG moniker or the sustainability moniker. And C contributing to solutions. Now, we've seen a lot of capital go into the C bucket because what strategies fall in there? Well, that's our climate change and energy transition strategies. But that's also strategies that are focused on impact in healthcare. Could be healthcare strategies, could be education strategies, anything that really aligns with the UN Sustainable Development Goals fits into C. You have seen a transition on how people have moved. Historically, back in the late 90s, early 2000s, it was all about the A, avoid, screen out. Right now, it's been focused on the B, I should say, maybe for the last 3 years. We've moved towards the C. And that's where you're seeing parts of the stock market be really overvalued. If you look at hydrogen, much of it is predicated actually on lower renewable energy prices out in 2035. Seems a little lofty to me, but let me just be clear. There is a lot of opportunity here and people just don't. It's about thinking about the investments holistically. Yes, that's obvious. That's associated with climate change. You have policy pushing money and capital into that direction. But the biggest winners in the transition to the low carbon economy are going to be low carbon producers and high carbon industries. And the biggest losers are going to be high carbon intensive producers and high carbon industries. So what do I mean by that? Let's take the aluminum industry. Historically, a very dirty industry. It is very carbon intensive to produce aluminum. But let's take a step back. What's key to everybody meeting their fuel emission goals on a global basis? Lightweighting. And you can have all the EVs in the world, but you're still going to need to lightweight. And aluminum and carbon composites and other dirty industry are all part of that. So we're focused on identifying who are the low carbon producers within those industries, who is already producing aluminum with hydropower, because they're likely to be the ones that not only survive, but actually thrive in the future. So yes, are parts of the stock market overvalued? Yes, that's always the case. But I actually think there's great opportunity when you start thinking about things and peeling back the onion.
Yeah, when you talk about aluminum, I can't help but think of, I'm involved in an organization trying to reduce lead pollution, which is a huge problem in the world. 1/3 of children in the world have lead poisoning in their blood. And it comes mostly from recycling of car batteries. But when we talk about clean tech, solar and wind, most of the batteries that are used to store that power are going to be lead. So, again, what's clean, what's dirty is always something that we need to take a close look at. I think we have time for one question, and I'm going to try to combine two, and this is probably not fair because we only have like 4 minutes, but let me throw the first swing at this bat at Okamura-san. Somebody is saying ESG discussion seems to be focused mostly on E factors. How can we bring more discussion on S and G? And my comment, and then the second question is, what about Toshiba? What does Toshiba mean for ESG? I would throw it back at you, Okamura-san, by saying, to me, it seems that Japan is still very much focused on G. We're still really struggling with the G. We are starting to address E and S, but the main struggle is G. And I would offer that that's what the problem of Toshiba is. But why don't you lead off by saying where we are in Japan on the continuum between E, S, and G. And if you want to make any comments about Toshiba, please bring them on.
I'll answer your first question for sure. Look, in our view, we need to address governance first and foremost, because if the governance wheel doesn't turn in the right way, the environment and social wheel doesn't turn the right way, and neither does the business, the mid to long term. And what we seem to forget is that, especially in the large cap space, it's great that we're seeing companies focus on ERS, but the problem is that the governance part has not necessarily caught up, and there's a bit of a mismatch there, and we think that that's not actually ultimately contributing to sustainability, because at the end of the day, if the top management are not committed to addressing these issues, then these issues are not going to be sustainably addressed for the mid to long term. So the matters of governance is actually very important, and especially in a market like Japan, where if you compare it to the rest of the developed markets, the independence ratio, the gender diversity ratio, the foreign nationality ratio is still very low. So we need to bring that up as much as we can to the global level. And the recent revisions to corporate governance code have attempted to do that. And we're over the next 12, 24 months, I can assure you, we are going to see some interesting changes in this market, because a lot of companies that we're speaking to are eyeing the revisions, as well as next year's prime market, Tokyo Stock Exchange prime market switchover as a key catalyst to making those changes. And from there, I think we're going to see a lot of discussions on ENS.
Great. And can I just quote you as saying that the problem of Toshiba is a G problem?
I'll let you say that, but yeah.
Yeah, no, I think one of the interesting observations I would make about Toshiba, I mean, we spent a lot of time talking about independent directors in Japan, the need for more, the need for more diverse, but yet the executive directors, the internal directors at companies like Toshiba often have no idea what's going on in the company. They're so siloed. They might know what's going on in their elevator business division or their HVAC division, but there's no secretariat. There's no way for people at the board, whether they're internal or external people, to really understand the company in its entirety and how it lines up with its competitors domestically and internationally. For me, that's a big challenge.
No, you're absolutely right. I'm just going to give you a very quick response to that. That is actually very important. And this case is going to be a litmus test for how Japanese companies should be embracing the value add of a board. Companies that actually embrace the board as a value add to their business fundamentals and long-term strategy, that comes together and it weaves together. In the case that we've been speaking about earlier, I don't think that was the case, and I think that's why we are seeing that the board failed to operate in terms of what it's supposed to be doing.
Yeah, and Sarah, can I give you the last look at you were talking about DE&I. I think it comes as a surprise to many people outside of America who have the impression that we're just climate. But you've seen in the last year and a half, that the focus has shifted away to climate and more towards these issues. Am I right in saying that? And do you have any comments on whether that trend whether climate will recover as the top issue?
Climate is back as the top issue, particularly with COP26 quickly approaching.
Oh, right. Yes.
I say 2019 was the year of Greta. 2020 was the year of social issues with the COVID and inequality issues we had here in the US, and the pendulum has swung all the way back in most places other than the US. All of our data and studies continue to show that the US investor is much more concerned about the treatment of worker and diversity and inclusion issues than our global counterparts. So not quite as focused on the environmental side, very much focused on the governance and the social side. And I just want to leave with something, because I thought of this, and it was a great quote I heard when you were speaking. And someone had once said that G is the mother of ENS. And if you don't have good governance and you don't have the ENS embedded in the ecosystem and that oversight by the G, you're never going to make the progress that you need to make.
Yeah, I have a classmate who's a fund manager in Tokyo who owns his own asset management company. He says, we used to just call this stuff good management. Just a little simple, but it makes the point. In any case, there's about 30 really good questions in the Q&A queue. And I just want to say to anybody to a lot of people whose questions we didn't get to, if you want to email me, I will either send your questions on to Sarah and Okamura-san or try to get you some information on my own. But we're very sorry we didn't get to all the questions, and many of them were excellent questions. So I'm sorry about that. Maybe I just need to invite these two people to come back at some other point and we'll have a 3-hour debate or something, because there were many key topics I was looking forward to getting to discuss with them, and time's out. So it just remains for me to thank you so much, Okamura-san and Sarah for keeping you late, and Okamura-san for getting you to an early start on your day. Wish you a happy Friday in Tokyo, Okamura-san, and thank you so much, Sarah, for coming on. I really appreciated it, and I hope our viewers did too. So have a good evening. Thank you very much. I now just want to thank our speakers. Thank our sponsors, excuse me, without whose support none of our activities would be possible. And I always like to say that not only are they generous financially and allow us to initiate all the programs we do, but these people, the companies that you see here, they're all a tremendous source of ideas and inspiration and suggestions for research focus of all of here at CGEB. So I want to thank them on both accounts. So thank you to the audience. Thank you to our sponsors. Hope to see you at another one of our webinars very soon. Thank you.